Brent. I'm a certified financial planner. I've got many years of experience, and it's true no matter who I'm meeting with, almost no one has checked the funds that they're using in their retirement account to see if they're actually good, well-performing funds. Now, no matter who you are, whether you're just starting out or you're near retirement, your IRA or your 401k probably is one of your biggest assets, and you may have $3,000 or you may have $3 million. But if you're like 95% of the people I've met with, you haven't checked to see if you're invested in good funds inside of your plan. So today I want to share with you, one, why that's important, and two, how you can go ahead and check to see if you have a good performing fund. So I have on the screen right now just a hypothetical example, and the idea is I'm comparing what the outcome could be if you had a good fund and what if you had a bad fund. So the first example here is that what if you're 30 years until retirement, and maybe you're adding $500 a month, and maybe your current account is worth $50,000. Okay, in this example, if you're getting a 7.5% return, let's say that's like a fund that's not performed particularly well, over that time you'd have over $1.1 million. Still pretty good, but if you have a good fund, you could expect that your performance hopefully could be 1 or 2% better over time, over that whole period. So in this illustration, I'm showing you a hypothetical good fund that had a 1.5% better return and did 9% annual. And you can see that in this example, it's a much better outcome for folks. So that's $500,000 of additional resources just for doing a 2-minute checkup one time a year. Just like you go to the doctor once a year, this 2-minute checkup will put you ahead of 95 or maybe even 100% of people. I don't know if anyone's ever come to me and said they're in a good retirement account, but you can be that person. So I want to show you how you can do it. It's a simple process, just a few steps, and it will take less than 2 minutes. So start the clock now. The first step you want to do is go to your retirement account at Fidelity or Vanguard or whomever, and pull up your account and look at what fund you're invested in and find the 5-letter symbol. Then step 2, enter it in Google, okay? And what you're going to do is scroll down. You'll see it here like I have on the screen. I looked up the Vanguard Prime Cap Fund. That's a very common fund for folks in 401ks. This is not an endorsement. This is not a recommendation. This is just a hypothetical example. But if you scroll down, the tool I like to use is Morningstar. And you can see in this case, it's the second option that comes up. So I'm going to click on Morningstar. This is a great tool. I've used it for almost 20 years. It's free, and you can do the exact same thing I'm doing on the screen right now. So the first screen that comes up is great, but we're going to ignore that. We're going to click on this icon here, the performance, and we're going to scroll down a little bit. It looks a little complicated, but please bear with me. We're going to scroll past the mountain chart, and we're going to scroll down to the trailing returns. Now, this is just a snapshot of what returns have been, and we want to focus on a 3, 5, and a 10-year number. And it's showing us some really important data. So in this fund, let's focus on the 5 in this example. You can see this number here, 68. That means that 68% of funds that do the exact same thing as the Prime Cap with the same objective have outperformed it. And then you can see here that there's a Morningstar tracks over 1,100 funds that do something similar. Okay, so that's not great return. Over 10 years, it's done a little bit better, but over 3 and a 5-year period, this fund has done pretty poorly compared to peers. The index, if you just had the flat index, did 15.7%, and then the fund itself, you can see, underperformed by 3%. That is double what the example hypothetically I just showed. So please do this. Please check up on your accounts at least once a year. It only takes 2 minutes, and you can look to find funds that are underperforming and try to find funds that have better longer term results. Now, we don't want to go chasing returns. We just want to be avoiding the funds that have perpetually underperformed. And I think if you do that, you'll have a much better chance of having a happy and successful retirement.